The real question, Joe, is whether this broadening can continue. If it was a moment in time, those who wanted to be in mega caps were in. Rates had come down enough, and there seems to be growing optimism about a soft landing, that it's like, okay, let's pick off these other low-hanging fruit areas of the market that I mentioned, real estate, discretionary, financials, industrials. Can it continue, and if so, how?
I think it can, and I think it absolutely will intensify in the beginning of 2024 in January and February. That is, if you study history, that is the seasonally strongest period for small caps. We're clearly seeing, in addition to small caps beginning to outperform recently, that it's the equal weighted strategy, of which obviously I am implementing one in the market, so I could tell you that it's working currently. Equal weighted strategies are working as well. So,
well, you're buying more of your own ETF because you want more equal weight exposure.
Absolutely. I want the equal weighted exposure. Last week,
talk about eating your own cookie.
I sold out a little bit of some strong gains that I've had year to date in 3 equity names. We talked about it on Friday. Take the capital, deploy it in the equal weighted strategy. But you asked, how does it continue? And I really think it's just all about studying where are yields. Yields are so critical in this conversation right now. As long as yields are going to stay anchored below 4.5% and can position themselves to ultimately make that move below 4%. And that trigger below 4% to me is so incredibly critical. I'm a little suspicious in the near term that we're able to break below 4%. We discussed that on Friday. I think maybe 4.10 might be an area of support. But if you get this market below 4%, I think you're going to see a lot of capital coming out of cash into risk assets, both for taxable fixed income and for pure equities themselves. And in pure equities, they're going to go to the underperforming areas of the market.
Joe, I'm not sure I want to see that 10-year below 4%. That kind of worries me. That's part of this whole 4 cuts thesis. I'm not saying you're saying 4 cuts, but these are things that if they happen, it's likely, because my thesis that the economy is just doing fine and we should all be bullish is wrong, right? I mean, below 4% is implying 4 cuts. The Fed's only going to do that if there is severe cracks in the labor market and we're teetering on the edge of a recession.
Can it be on better inflation?
I think that's where you get the 2 cuts, and I think that's where the 10-year is right now. Obviously, this is not written on the front page of the Wall Street Journal. This is opinion. My opinion is that if you go below 4% on the 10-year and you're really looking at 4 cuts, it's because it's a bad situation that we don't want.
Okay. Well, I mean, you're at 427. Remember, what was there, a point last week where it was like, wow, are we going to go under 4 by Thursday, by the end of the week?
Thursday afternoon. If you had conversations with fellow speculators in the financial services industry, everyone was saying to me, we think we're going to go below 4% tomorrow on the jobs report.
Until the jobs report came out, though, unemployment rate actually went down. So the jobs number was somewhat benign. I mean, it was a tiny bit hotter than anticipated, but it was the unemployment number, because the wage number was pretty good too, in a positive way, and then we had a little bit of a pop in yield. So now that just raises the ante even more on CPI, PPI, and then Powell himself.